monsoon could be a risk, but that is where we showed that the irrigation levels and the estimates of production and the buffer stocks, etc., are all pointing to a lot of risk management, risk mitigation parameters that would keep any potential impact of a weaker monsoon, if it were to happen, on the price side and the output side muted. So inflation trajectory will be influenced going forward by the following factors: pass-through of lower input costs, bumper harvest, healthy prospects for Kharif season, and internationally commodity prices are expected to decline in 2023, even if they are still higher in absolute terms than the pre-pandemic levels. Turning from domestic demand and inflation to external situation, merchandise export growth, as expected, were lower in Q2 and Q3, but in Q4 it staged quarter-on-quarter recovery, even better than the Q2 levels, which is, I think, a good sign given slowing global demand, and that has contributed to a moderating merchandise trade deficit. But more importantly, all of us know that the surplus in services trade has been rising, which is what is contributing to a very subdued expectations of current account deficit, even for the current financial year, with many forecasters pointing to a number that will be less than 2%, that will be even better than 2% of GDP for the current account deficit in 23-24. And after some hesitation on the part of the foreign portfolio investors in the closing months of the calendar year 2022, they have returned to the Indian market, sensing the importance and the virtues of macroeconomic stability, higher growth rates compared to major economic powers, and overall financial and macro stability. And the forex reserves, which declined during the course of the last financial year, especially in the first half, are coming closer to the kind of peak levels we saw in April-May 2022, heading towards $600 billion on the back of a declining trade deficit and improving foreign portfolio investment flows. Well, all of us have been waiting for the capital formation in the private sector to pick up. One of the important leading indicators is the import of capital goods, even not more than the overall import numbers. We keep track of the import of capital goods, which actually did underperform in the second decade of last year, is the second decade of this millennium, which is what reflected in the low capital formation because of balance sheet problems faced by the corporate sector. But now in the current financial year ending March 2023, capital goods imports picked up quite well compared to the previous year, growing by almost 20%. And increased production of capital goods domestically and construction and infrastructure good index complement the growth in the import of capital goods, auguring very well for a pickup in the private sector capital formation, which is what we see in the new project announcements by the private sector, captured in many other private databases as well. And bottom-up data based on the financial results of companies submitted for March 2023 indicate that private sector capital formation is beginning to unfold. And as we get full data for the corporate sector in the coming months, we will see that it is no longer a prospective story, but a current reality, that the private sector capital formation cycle on the back of high capacity utilization and robust demand has begun to take place already. And as you can see on the right side, growth in private investment in several sectors in FY23 compared to FY22 are listed here, excepting the three sectors in the bottom. Every other sector has seen a healthy improvement in capital formation rates in FY23. Today also we saw the release of the fiscal deficit numbers. In fact, for the financial year ending March 23, in terms of 2 decimal places, it would have been 6.36%, but it is 6.4 in terms of first decimal place as budgeted and as revised. And therefore, we are on track on the back of sustained economic growth to achieve 5.9% budgeted for the current financial year. And that is why the continued emphasis on capital expenditure will also be expanding the potential growth rate of the economy, contributing to prospects for non-inflationary sustained economic growth in the remainder of the decade. And that is what is also signaled by the fact that financial cycle in India, which went through a downturn in the second decade, has also turned the corner, as we will see later, and a combination of better financial health in the banking and in the non-banking sector, and the infrastructure improvement contributing to removal of bottlenecks, and private sector capital formation catching up to meet increased demand, should actually augur very well for an elongated economic cycle in the country than in the previous decades. On the fiscal front, of course, apart from the capital expenditure thrust, also the brighter picture comes from the improvement in corporate tax collections and in the personal income tax collections, both of which are growing neck to neck in terms of the actual tax collected, both from the corporate sector and from the personal sector. And on the indirect taxes side, of course, goods and services tax, the average level shift apart from the pandemic year has been noticeably sharper even in 22-23 and beginning quite well for 23-24 as well. In terms of labor market, the quarterly urban unemployment rate is down from a peak of 21% or 20.8 in the pandemic-induced, pandemic-heavy quarter of April-June 2020, down to 6.8% in the quarter ending March 2023. In terms of the creation of formal employment, based on the average net additions to the Employee Provident Fund organization, you can see that the FY23 average level has been much higher than the previous 3 financial years, and these are good indicators of the health of the labor market in India. And in terms of a start to the current financial year, we did mention in the monthly economic report which we put out, the April monthly economic report was released in the 3rd week of May, and we did say that while in the economic survey, we mentioned that 6.5% was our target or an estimate of the real GDP growth for this financial year. But we also mentioned that the risks to the downside were higher. But now we are prepared to stick our neck out one more time and say that the risks to 6.5% are probably more evenly balanced. That is, there is as good a chance that this number may be exceeded as there is a chance that the reality may undershoot this number. So we are prepared to say that the risks are more evenly balanced than what we felt 4 months ago, and the high frequency indicators for industry, services, external sector, fiscal and credit growth are all pointing to sustained momentum in the economy. Growth prospects therefore appear bright. External factors, as the RBI's annual report also indicated, pose downside risks because of geopolitics, because of what might happen to oil production, and also due to potential for further monetary tightening in some developed countries, and with it the attendant risks of further financial stress. But those are external factors which are well provided for in terms of the resilience of domestic demand growth in India.